The bear market might not be over yet, but you can start shopping for new quality stocks. Thanks to Morgan Stanley, they have just released their top 30 stock picks for 2025 and have found some high-quality stocks you might not be expecting. Looking for quality stocks is a difficult and sometimes long process. You're probably on the lookout for companies that generate a lot of profit, have a low amount of liabilities, and grow in a sustainable way. Thankfully, researchers at Morgan Stanley may have just made the hunt for quality stocks a little easier. The 30 for 2025 list looks at ranking quality companies for longer-term investors. How to make the list. When picking out a quality stock, investors typically have a long list of characteristics that they look out for, such as pricing power, capital intensity, management quality, and a strong balance sheet. So Morgan Stanley came up with an 11-point checklist and scored 30 quality-orientated companies against each other. In this video, we will be looking closely at the top 3 companies, how they are set to be such a strong stock to invest in, and the results might surprise you. Stock 1. Prologis PLD. Taking the top spot of the list was Prologis, a real estate investment trust specializing in logistics. Prologis owns and rents out giant distribution centers to the world's leading logistics firms, think DHL or Amazon. There are a few reasons Morgan Stanley likes this stock so much. Firstly, the average length of a rental agreement for their facilities is around 7 years. I'm sure you've noticed that there are a lot more things being delivered these days to both consumers and businesses, and that's boosted the rent that distribution center owners can charge. According to Prologis, rent for its US and Canadian distribution and fulfillment centers jumped up by a record 34% last year. Take a look at this graph. It shows the market rental rate in US dollars per square foot for large facilities, going back to 2006. Looking forward to the next few years, the company's rental agreements are coming up for renewal. Prologis should be able to extract higher payments and revenues over time. Secondly, building these huge fulfillment centers is an expensive task. There is plenty of land in the US, but finding a good location is crucial to the amount that can be charged for rent. The reason for this is big logistics firms want to maximize efficiency in every way they can. Reducing the distance their trucks have to travel is a key aspect of minimizing costs. What's more, the cost to put these centers together has soared recently as commodity prices have climbed. Adding these two factors together, Morgan Stanley thinks Prologis is in a great position, likely to benefit from a very favorable supply and demand imbalance, with plenty of opportunity to keep increasing its prices. Stock 2. JP Morgan JPM. It's uncommon to see a bank on a list of quality stocks due to a lot of unpredictable factors, such as macroeconomic data and interest rate movements, impacting a bank's ability to make profit. However, if any stock was going to make the list, it would be this Wall Street titan. And the recent major bank fails would have only reinforced one of Morgan Stanley's central arguments: the strong get stronger when it comes to banking. Morgan Stanley thinks that JP Morgan's market share gains are set to continue. The bank has been opening up new locations across the US. Additionally, JP Morgan has the newest stores out of its competitors. It's likely that these local branches will help pull in customer deposits. On top of this, JP Morgan's been ramping up spending in recent years to improve its technology-leading product offerings. Morgan Stanley sees the spending has started to tail off, so if revenues continue to climb higher, that's a formula for growing profits. Stock 3. Old Dominion Freight Line, ODFL. As all investors know, past performance is not an indicator for future success. But if it were, Old Dominion would be a world champion. The trucking firm has an astonishing 15-year record of more than 10% annual sales growth and 20% earnings per share growth. As with the banking industry, trucking has not always been synonymous with quality, facing macroeconomic crosswinds and a lack of independent growth drivers. Having said that, ODFL has been able to maintain strong performance through various economic cycles over the last of its 15 record-breaking years, showing signs of being a high-quality stock. Old Dominion's management use a counteractive approach to investing, which is commonly used in the best-managed firms. This means that when the economy falls on hard times, the company doubles down and invests heavily into new trucks, new initiatives, and new routes, while its weaker competitors try to cut spending in order to survive. This strategy is successful in almost any industry, and Old Dominion is no different. The trucking industry isn't famous for high growth, but Morgan Stanley have identified a few factors that might help sales growth to continue. Firstly, regulation costs have soared, increasing the barrier to entry for the industry, meaning Old Dominion faces fewer competitive threats than it did before. Secondly, as companies look to shorten supply chains, trucking is a shorter and faster way of shipping goods than by rail, driving up Old Dominion's demand. Lastly, technologies like autonomous driving or semi-autonomous driving help ODFL to cut costs and fatten its profit margins. How can you invest in quality companies? To get started, you could invest in any of these 3 companies from Morgan Stanley's 30 for 2025 list. Their tickers are PLD, JPM, and ODFL. An alternative could be to invest in one of the most popular quality-oriented, exchange-traded funds, the iShares MSCI USA Quality Factor ETF. Ticker QUAL, expense ratio 0.15%. Let me know your thoughts about these 3 stocks. Will you consider investing in them over the next few years? As always, thank you for watching, and I will catch you all in the next one.